Have you ever pondered the intricate workings of the SVOL ETF? It's a fascinating world indeed. Let's unravel this mystery together. First things first, understanding the SVOL ETF starts with getting to know the VIX. The VIX, or the Cboe Volatility Index, is the heartbeat of the stock market. It measures the market's expected volatility, which is just a fancy way of saying how much investors think stock prices will swing in the future. When the VIX is high, it's a sign that investors are nervous and expect large price swings. Conversely, when the VIX is low, it indicates that investors are confident and expect smaller price swings. Now, how does the SVOL ETF fit into all of this? Well, SVOL is like a surfer riding the waves of the VIX. It invests in short-term VIX futures contracts, which are essentially bets on where the VIX will be in 1 to 3 months. If SVOL thinks volatility will increase, it buys VIX futures. If volatility indeed surges, the price of these futures contracts rises and SVOL emerges victorious. But what if the opposite happens? What if volatility falls? Well, in that case, the price of VIX futures contracts drops and SVOL finds itself on the losing side. So, how does SVOL make its money? It profits from two main sources. The first is an increase in volatility. When the VIX rises, the value of the VIX futures contracts that SVOL holds also increases, leading to gains. The second source of profit is the price spread. SVOL can buy VIX futures at a low price and sell them at a higher price, reaping the difference. However, there's no such thing as a free lunch. With the potential for profits comes the risk of losses. SVOL can lose money in two primary ways. The first is a reduction in volatility. When the VIX falls, the value of the VIX futures contracts that SVOL holds decreases, leading to losses. The second is a poor prediction. If SVOL buys VIX futures at a high price and sells them at a lower one, it incurs a loss. Finally, it's important to note the risks associated with SVOL. The value of SVOL can plummet dramatically if volatility drops significantly, presenting a volatility risk. Liquidity risk is another concern, as VIX futures may be difficult to buy or sell during periods of high volatility. Lastly, SVOL is a complex product that may not be suitable for all investors, underscoring the importance of understanding the product before investing. In summary, the SVOL ETF is a complex product that bets on the future volatility of the stock market. It makes money when volatility increases and loses money when volatility decreases. The risks associated with SVOL include volatility risk, liquidity risk, and the risk of poor predictions. Understanding these elements is key to making informed investment decisions. So the next time you hear about the VIX and SVOL, you'll know exactly what's going on.
Δεν είμαι επενδυτικός σύμβουλος ή τεχνικός αναλυτής. Κάνετε τις έρευνες μόνοι σας και αγοράστε. Και επίσης θέλω να σας πω ότι κάτω από το link, το βιντεάκι μου, έχω τη Freedom 24 που δίνει όταν ανοίξετε ένα οργανισμό με $10, ας πούμε, δίνει μια δωρεάν μετοχή αξίας μέχρι και $700. Επίσης, εάν βάλετε μέχρι και $20,000, είναι ασφαλισμένα, λέει, και παίρνετε τόκο μέχρι 5,30. Αυτά.